A three-digit number decides whether you get the house, the job, the loan. It decides the rate you pay, the deposit you must put down, the doors that open, and the ones that shut. But it isn't cash. It isn't magic. It's a permission slip, a trust score. In the next few minutes, you'll learn what makes that number, why it matters, and the simple moves that actually raise it. Stick with me. First, what is credit? Credit answers one question. Can you be trusted with borrowed money? Think of it as a trust meter. The higher the number, the more lenders trust you. The lower it is, the more they worry. Banks, card companies, landlords, insurers. Even some employers read that meter. They don't read your heart. They read your financial track record. Picture borrowing a ladder to fix a roof. If the owner trusts you not to drop it, they lend it free. If they don't, they charge you or refuse. Credit works the same way, except the ladder is a mortgage, a car loan, a phone plan, or a lease. That three-digit number is the permission slip that opens the door. Credit isn't money in your pocket. It's an invisible score built from tiny choices you make over time. Paying on time. How much of your available credit you use? How long you've had accounts? Those choices add up into a number, and that number affects what you pay and what doors are open to you. Once you know what it measures, you can change it. And yes, change is within reach. So what actually makes the score tick? There are 5 levers you can reach. 1. Payment history. This is the heaviest factor. Did you pay on time? Lenders want proof you meet deadlines. Missed payments hurt. A single late payment can cost you. Set autopay, mark your calendar. Don't let a human slip become a permanent scar. 2. Credit utilization. Think of your limit as a bucket and your balance as water. The fuller the bucket, the riskier you look. Aim for under 30% usage across each card. Under 10% if you want top-tier access. Lower utilization by paying down balances, spreading charges across cards, or asking for a higher limit. Only if you won't spend the extra room. 3. Length of credit history. Old accounts are proof you've handled credit over time. A long track record builds trust. New accounts are blank pages. Don't close old fee-free cards just because you're tidy. Age matters. 4. New credit and inquiries. Every application writes a hard inquiry. To many in a short span, looks desperate. If you're shopping rates for a mortgage or auto loan, do it in a tight window. So scoring models treat those checks as one event. Don't spray applications around like confetti. 5. Credit mix. Revolving accounts, cards, and installment loans, student or auto loans. Together show you can manage different debts. Mix helps. But don't take a loan you don't need just for variety. Purpose beats vanity. Those 5 things combine into your score. The math behind the scenes can look complex. The actions are not. Small habits, timely payments, lower balances, leaving old accounts open, stack into big movement over time. Why should you care? Because this number changes real things, real bills, real opportunities. Imagine 2 people with identical paychecks. One has a strong score, the other does not. The strong score person gets a lower mortgage rate. That rate difference saves hundreds a month, thousands over the life of a loan. The same car can cost thousands more with a worse rate. A low score can mean bigger deposits for utilities, being passed over for a rental, or paying higher insurance premiums. Even employers sometimes use credit as a proxy for responsibility. A few points can become a big bill down the road. Now let's clear the common myths, the misleading stories that cause bad decisions. Myth: you only need credit if you want debt. Truth: credit is a tool. Good credit gives options. Lower rates, easier approvals, smaller deposits. You can use credit wisely. Myth: closing an old card always helps. Truth: closing can shorten your history and raise utilization. If it's fee-free, consider keeping it open and using it occasionally. Myth: carrying a small balance helps your score. Truth: you don't need to carry a balance. On-time payments and low utilization build credit, not interest payments. Myth: paying off a debt removes marks instantly. Truth: payments take time to report. Some negative events remain visible for years. Prevention beats fixes. Myth: checking your own credit hurts your score. Truth: your checks are soft inquiries and don't hurt. Lenders' polls are hard inquiries and can have a small, temporary effect. Check your reports regularly. Myth: credit repair companies can magically erase negatives. Truth: some dispute real errors legitimately. Many promise too much for a fee. You can dispute errors yourself for free. Myth: multiple credit checks always ruin your score. Truth: context matters. Rate shopping within a tight window is treated as a single event. Random applications, however, can add hard inquiries. Myth: student loans ruin credit. Truth: managed well, they can help by adding payment history. Missed payments, however, are the risk. Myth: co-signing is harmless. Truth: co-signing makes you legally responsible. If the borrower defaults, your credit suffers. Only co-sign if you can pay. The truth is simple. Pay on time, keep balances low, be intentional about new accounts. People want hacks. There aren't magic fixes. There are high-impact moves that consistently change the score. Move 1. Pay on time. This is the heavy hitter. Auto-pay minimums now. Better, schedule a second payment each pay period to reduce principal. Pay before the statement closes when possible. It lowers the balance lenders report. If cash is tight, call your creditor and arrange a plan. Communication beats silence. Move 2. Cut utilization. Aim for under 30% per card, under 10 to 15% overall if you want elite levels. Quick wins. Pay down the highest utilization card first. Spread charges across cards. Ask for a credit limit increase if you've been responsible. Consider balance transfers only with a strict payoff plan. Watch fees and timelines. Move 3. Keep old accounts alive. Cage helps. If a card has no fee, keep it open. Put a small recurring charge on it and autopay it so it reports as active. Move 4. Be smart with new credit. Limit hard inquiries. If you must shop rates, do it in a short window. Each application should serve a clear purpose. Move 5. Use a sensible mix. Having both revolving and installment credit can help, but don't take loans just to diversify. If you want action now, here are practical moves you can do this week. Turn on autopay for minimums. Pay one card down to bring its utilization under 30%. Call one issuer and politely ask for a credit limit increase if you've been on time. Add a $3 to $5 recurring charge to an old, unused card and set autopay so it stays active. Freeze new applications for 60 to 90 days while you repair balances. None of it is glamorous. It's habit work. Habits beat panic. Now, traps to avoid. Trap 1. Co-signing. You become responsible for another's debt. Say no unless you can pay. Trap 2. Payday loans. High fees that trap you. Call your bank or ask friends before taking one. Trap 3. Ignoring small debts. Small past due amounts can go to collections and devastate your profile. Call creditors, negotiate, get agreements in writing. Trap 4. Paying for quick fixes. Many paid services promise instant boosts. Dispute real errors for free first. Trap 5. Balance transfers without a plan. Promos end. If you can't pay within the term, you'll be worse off. Trap 6. Opening accounts purely to boost credit. New accounts mean hard pulls and shorter history. Only open accounts with a purpose. Trap 7. identity theft. Fraud can tank your score. Check reports regularly and act fast on unknown accounts. Trap 8. Hiding financial problems in relationships. Joint cards and co-signed loans can drag both parties down. Be transparent and plan together. What to do instead? Pause, call, negotiate, and document. Small actions early prevent big problems later. Credit sits inside a larger system. When used sensibly, it fuels growth. Homes, businesses, education. But misused, it causes crises. Think 2008. That crash came from risky lending and roll-ups of bad loans. The lesson: credit is powerful, and it needs guardrails. Alternatives like credit unions, peer lending, and microloans show there are more human-centered ways to borrow. So, how should you think about credit? Shift your mindset. Treat credit like a tool, not a boss. 3 mental rules. Purpose first. Borrow for things that add future value. Reliable transport for work. Education that raises earning power. A mortgage for a home you'll keep. Cost second. Look at the total cost, not just the monthly payment. A long loan with low monthly payments can be very expensive. Plan third. Have a repayment plan before you sign. Know where the money will come from and what you'll do if things go wrong. Practical habits. Pause before applying. Give major decisions a cooling-off period. Translate interest into real dollars and reward restraint. 2 habits move the needle most. Pay on time and keep utilization low. Everything else is maintenance. Do those 2 consistently, and the rest follows. Here's a short checklist you can do in 1 hour. Pull your free credit reports and save PDFs. Scan for errors. Turn on autopay for minimums and verify the funding account. Make a payment to the highest utilization card to bring it under 30%. Add a tiny recurring charge to the oldest card you want to keep active and set autopay. Freeze new credit applications for 60 to 90 days. Set 2 reminders. 1 the day the statement closes, 1 a week before the due date. Start a $500 emergency buffer. Small, steady deposits. If you have a missed payment, call the creditor now. Use this script. I want to make a plan to bring this current. What options do you offer? Take notes and get confirmation. Expectation check. You won't fix everything overnight. Small improvements appear in 30 to 60 days as reporting cycles update. Bigger changes can take 3 to 6 months. The power is cumulative. Tiny, consistent actions beat one-time heroics. Final thought. That 3-digit number does not own you. It's a tool you build and use. Pay on time. Keep balances low. Be intentional. Those 2 habits will bend the number in your favor and open more doors than you might expect. If this helped, hit subscribe for more simple finance lessons. You control the 3-digit number, not the other way around. Start today.